It's always a relief when tax season is over, right? But then again, tax season is never really over. Hello everyone, I'm David Scranton. You know, you may leave behind a lot of things when you retire, but your tax burden is not one of them. In fact, taxes can potentially be an even bigger burden during retirement. And the keys to avoiding that problem are awareness and planning. And on today's show, we're going to share some things that could help you minimize your retirement taxes. We'll be covering how different types of retirement income are taxed, some recent tax law changes that you should know about, the biggest tax mistake to avoid, and also share with you some evergreen tax strategies that could help you year after year in retirement. And helping me out as usual is income specialist and best-selling author Jeff Small. But we're also going to be hearing from our special guest, author and economist, Dr. Laffer, as well as income and tax specialist David Mcadams and Joann Regan. But first, let's talk about how different sources of retirement income are actually taxed. And let's start with the good news. If your only source of retirement income is Social Security, well then you probably won't pay any taxes. Why? Because Social Security income by itself is tax exempt. Now, for the bad news, if you're like most people, Social Security won't be enough. You'll need other sources of income, which means that a portion of your Social Security income probably will be taxed. As for how much will be taxed, it varies, but it can run as high as having to claim 85% of your Social Security benefits as taxable income. For example, you'll probably pay that 85% if you get large monthly income payments from a pension. As for the pension itself, most pensions are funded with pre-tax income. And if that's the case, it means all of your pension income is taxable each and every year. However, if a portion of your pension was funded with after-tax dollars, then only a portion of the income will be taxed, right? Makes sense. But as for investment income from interest, dividends, or capital gains, naturally you'll have to continue paying taxes on that just as you did before you retired. Now, if your strategy is to systematically sell investment shares to generate retirement income, what does that mean? Well, in that case, each sale would also generate a long-term or short-term capital gain or capital loss, which of course you'd have to report on your tax return. Now, I should also point out that in many cases, this is a very bad strategy. We talk about this a lot. For most people, your main source of retirement income besides Social Security is the money in 401ks and IRAs, and those accounts are tax deferred until you start to take withdrawals, which of course the IRS forces you to do when you turn age 72. These pesky things called required minimum distributions, or RMDs. And these RMDs are unavoidable even if you have plenty of income from other sources. And that makes having the right plan to satisfy your RMDs one of the most important parts of retirement planning, and minimizing your tax burden is only really one reason why. Something we'll be talking about more coming up in just a bit. But first, one of your questions. Gina from Florida asks, is there a way I can determine ahead of time how much of my Social Security will be taxed? Well, Gina, yes, you can do that. What you have to do is go to your tax professional, or if you do it yourself, take your tax software and do what's called a pro forma tax return, where you pretend you're retired today, you put in your pension amounts, your projected Social Security amounts, how much other income you're going to have from other sources, and you have to make all these projections, and you'll get a pretty good guesstimate, assuming you're not too far away from retirement, as to how much of that Social Security will be taxed. So Gina, thank you. And also be sure to send me your retirement questions by emailing me at askdave@theretirementincomeStore.com. Now, Jeff, I know we talk a lot about investments on the show. We don't get to talk as much about taxes as we probably should, but at the end of the day, it's not just, about a penny earned. It's about what you keep after you earn that penny, right?
Well, there's no doubt about that, Dave. And, when we have income or whether we have growth, people are always concerned about the tax burden. But since most of the retirees out there in the income generation have the majority of their wealth in IRAs and 401ks, guess what? There's only tax when you withdraw. There is no tax when you either realize a capital gain or you have interest earnings from fixed income assets, which is a good thing, by the way.
Well, that's important because a lot of people in the brokerage business, stockbrokers, I mean, and a lot of investment advisors whose business models are stock market based, they want to keep their clients in the stock market as long as possible. So often they'll talk about how income-based investments could be taxed more heavily than growth-based investments where you have to pay capital gains tax. But they conveniently fail to mention that at the end of the day, if a majority of your money is IRA or 401k,
And that's a good thing, but not every source of cash flow from your investments can be taxable. If somebody's just taking voluntary withdrawals from savings to pay for things or to augment to their income occasionally, well, that's not taxable, Dave. So they're not increasing their taxes, but they're increasing their income.
Yeah, an important thing for people to understand is the difference between cash flow and income, right? Income is technically interest and dividends, but cash flow can be something different. So Jeff, I know you've had plenty of people who've said that, who said, hey, my early years of retirement, I've got this deferred compensation plan that's paying out. It's going to be giving me a lot of income. I just want to save money spend money I've saved in the bank. So essentially they're taking principal, and of course that principal always comes out tax-free. And the same is true if the market's up and they want to sell some stocks or some mutual funds. Yeah, they have to pay capital gains on the gain, but once they sell it, the principal part is something they can get tax-free. So great comment. I mean, I know we're going to talk about municipal bonds and things like that a little bit later in the show, but you're right. Cash flow and income are different, and the cash flow doesn't always have to be taxable.
Dave, and we've had the Secure Act too, which is impacting taxation, because I think the Secure Act, I find nothing secure about that act because it hammers beneficiaries when they receive the IRAs. So non-spousal beneficiaries, when they receive IRA or 401k money, now have 10 years to pay out all that money in an after-tax fashion, which means those withdrawals are all going to be taxable. So there's nothing secure about that for beneficiaries, except the government is securing taxation.
Well, it's interesting. They're pushing the RMDs back to age 72. They pushed them back. Now they're going to 75 if they get their way, and that's okay. But most people need to take withdrawals before age 72 or 75 just to augment their Social Security. So I don't think it's gonna really help people as much as the government thinks. But they have to pay for that somehow. How they pay for it, you're right, on the back end when you die. And again, I think it goes to the thing that dead people don't vote. So why not get rid of the step up in basis on capital gains? Why not tax IRAs more heavily at death? Right? I mean, dead people don't vote. So that's the theme of the show, perhaps. And in a moment, we're going to bring in today's special guest, Dr. Art Laffer. But first, we're going to talk about some recent tax law changes that can affect your retirement plan. All this and lots more coming up right here on The Income Generation.
Are you truly ready to retire? Do you have the right strategy to pay for your lifestyle for the next 30 years or more? Take our free retirement readiness quiz at areyoureadyforretirement.com and discover what your retirement strategy may be missing. Don't let market volatility derail your retirement plan. Make sure you're fully prepared by learning about hidden risks to your retirement. Visit areyoureadyforretirement.com and take our free retirement readiness quiz.
Welcome back to The Income Generation. I'm David Scranton, and today we're talking about different ways to help minimize your retirement taxes. And so far, we've looked at how different sources of retirement income are taxed. And now let's bring you up to speed with some important tax law changes. In 2019, Congress passed the Secure Act, the most significant piece of retirement legislation in years. And it included several key changes that affected tax strategies. One of the biggest was raising the age for taking your first required minimum distributions from age 70 and a half to age 72. And that gives you an extra year and a half to grow your retirement accounts tax-free. The age is expected to rise even higher over the next decade or so under the Secure Act 2.0, which has already been approved by the House Ways and Means Committee. If it's signed into law, the Secure Act 2.0 will actually raise the RMD starting age to 75 by the year 2032. It will also expand several other provisions, those that are already in place under the original Secure Act. That bill did the following. First, it eliminated the age limit for contributions to a traditional IRA. Next, it raised contribution and catch-up contributions for 401ks, 403bs, and simple IRAs. Then, it raised the Social Security wage base to $142,000 that you have to pay FICA taxes on if you're still working. And it raised limits on long-term care premium deductions all the way up to 100% if you're self-employed. In addition, the income ceiling for Roth IRAs went up under the Secure Act, which was the only real change to affect Roth IRAs. So does that mean that making a Roth IRA essentially, is it a better or worse tax tool than a traditional IRA? Well, that's something we'll talk about much more with Jeff coming up in just a moment. But first, let's get to another one of your questions. This one, Bob from Iowa. I've always done my own taxes. Do I need a professional's help once I retire? Well, Bob, good question. And the answer really depends upon your situation. If you're in a really, really simple situation where maybe you've got some money in an IRA and you have a good income specialist who's helping you with RMDs, then, probably not, because you're probably not paying a lot of tax on Social Security, or even if you are, typically the software programs, if you do it yourself, are helpful there. But if you've got different buckets of money, if you've got some IRA money and you have some non-IRA money, or you have flexibility as to when to take Social Security because you haven't taken it yet, or when to take your pension, then working with a tax specialist is important, because that person can help you plan to reduce your taxes in the future. So again, thanks so much for that. And if you have a question, just email me right here at askdave@theretirementincomeStore.com. Now, it's time to welcome today's special guest, author and economist, Dr. Art Laffer. Dr. Laffer, thanks so much for being back here with us on The Income Generation.
It's my pleasure, David. It's always fun being with you.
We spoke just 6 months ago, and you said a couple things. I was surprised to hear you say that you, at that point, weren't that worried about a Biden administration. You didn't think it would be as bad as some people thought. You said, gosh, if he could do 100 million arms in 100 days, that's a huge goal. That's great. And he did it. He seems to be at least trying to compromise with Congress, which is good. But what do you think is going to happen with this whole tax mess? How bad do you think it's going to be for Americans, especially retired Americans?
Yeah, I really do not think all of his tax stuff is going to get passed and get put through Congress. I really don't believe it will. I mean, here we have a 21% corporate tax rate that he wants to raise up to 28%. I don't see how he gets that to be very serious. What's he going to do? Raise the 37% tax rate to 39.6%? Raise the capital gains to 43%? No, I don't think Congress has an appetite for anything like that sort of stuff. Now, the minimum tax globally is one of the silliest ideas in the world. What we need is countries to compete with each other for business, not to collude against their electorates. And that's exactly what a global minimum tax does, is allows them to collude. So I think he's not going to do as well.
Think about it, Dr. Laffer. If corporations tried to collude in that way, they'd be taken to court, right? So
Yes.
You can't do that, and it's not even smart politics. But which parts, let's break this down. Which parts of this tax change do you think are most lethal versus those that are less lethal, right? We got the corporate tax raise, we got the capital gains raise, we got the raise in brackets, we got the removal of step-up and basis. What's the worst? What's not so bad? Tell us.
Well, for the retirees, the removal of the step-up basis is very, very serious. If you die and you have capital gains, we have something right now which steps up the basis before it gets any tax. There's no the accrued unpaid capital gains tax, unrealized capital gains tax is avoided. He would put that unrealized capital gains there, and he would raise the death tax. So that would be a very serious one if it were to pass. I don't think much of this is going to pass, David. And the reason I don't think so is I don't think there's any political appetite for it. I mean, if you look at what happened, the last Democrat who tried to raise taxes a lot was Bill Clinton. In 1993, if you'll remember that, he raised the highest marginal income tax rate to 39.6. And what happened is every Democrat every Republican running in the House for re-election was reelected. Every Republican running for re-election in the Senate was reelected. Every Republican governor running for re-election was reelected, including 2 under federal indictment. It is a political loser. This guy Biden will lose in the midterms drastically if he pushes this stuff through quickly. So I think the Democrats know that, and I don't think they're going to fall for the bait. I don't think so.
Okay. Tell me, do you think, generally speaking, that today's tax laws are fair for retirees and those approaching retirement, or do you think certain changes could happen that would make them more fair?
Yeah, I think the tax code is a hodgepodge of unfairness all the way through. What you really want to have on a fair tax code is people in similar circumstances should pay similar amounts in taxes. They should. And that's not a way our tax codes are. I think it's 70,000 pages of tax things. So all the lawyers and all the deferred income specialists and all the lobbyists and all that stuff get muddled in there. What we need is a low rate, broad-based, flat tax. No exceptions, no exemptions, no exclusions, none of that stuff. And you could do that with a 13% flat tax, which is what Jerry Brown proposed in 1992 when he was running in the primary against Clinton. And that would be the fair tax. That would be just the perfect tax. Just collect your revenues with a low rate, broad-based low rate to make sure that people are not incentivized to try to avoid paying taxes, and a broad base so they don't find places where they can put their money to avoid taxes, and just be done with it. That's the right way to do taxes.
Okay, so let's turn lemons into lemonade, right? Because that's all we can do if we have lemons. So that means that there are loopholes, there are legal loopholes, there are strategies that retirees can utilize to lower their taxes. So if you could point out 1 or 2 of those that you think might best apply to our viewers and our listeners.
Well, you know, one of the things that I've done is I've given my maximum amount to my children and grandchildren. I can, so I can avoid the death tax when they get it. You know, when I start a business and do something or invest, I try to transfer the low-priced stock into my family's names and into their trusts, so they get to keep that without having a death tax associated with it. You know, I try to keep my health care situation very carefully done, so I'm good. But when you look at retirees, you know, they should really remember, David, that it is true. You should make as much as you can, and you should pay as little tax as you can so you can make as much after tax as you can, and then you should invest that money as best you can. But remember the third one, and the third one's really make sure you spend your money well so you enjoy retirement. Make sure you use the money in a correct way. Don't go squandering it. Don't go to fancy high-priced restaurants where the caloric intake is too high. It makes you sick, and you have to pay a lot of money for it. You know, enjoy life the way it is. And there's so few retirees that really do enjoy their lives the way they should. I mean, I'm having a blast. I'm 81 years old, and I can't tell you how happy I am. And I don't spend much money at all. I mean, I don't find fancy things really pleasureful. I've got my little farm out in Kentucky. I go there. I've got my animals. I walk around and sniffle them. But that's what really should be done. Spend your money to make you happy.
Dr. Laffer, that's incredible holistic advice you don't often hear from an economist. And that's why our whole model is investing for interest and dividends, because the more income you have, the more choices you have, the more flexibility
exactly.
and so on. And I hope that the step-up in basis doesn't pass, but I have to tell you, because dead people don't vote, it might just be the easiest thing for them to jam through. So
I don't think so.
All good things must come to an end. Unfortunately, we're out of time today, but Dr. Laffer, thanks so much for being here with us again on the show. We really appreciate it.
It's my pleasure, David. Thank you very much for having me.
And coming up after the break, we'll talk about one of the biggest retirement tax mistakes to watch out for, and we'll have tax and income specialist Dave Mcadams also. You're not going to want to miss that. All that and more coming up on The Income Generation.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow The Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
Welcome back to The Income Generation. I'm David Scranton, And thanks for tuning in as we talk about ways to help minimize your retirement taxes. And so far, we've covered how different types of retirement income are actually taxed, along with recent tax law changes as well as pending changes. But now let's cover one of the biggest tax-related mistakes to look out for. As we mentioned, if approved by the House, the Secure Act 2.0 will further raise the age when required minimum distributions kick in, from age 72 to 73, 74, and ultimately to age 75 by the year 2032. And although that gives you more time to grow your retirement accounts tax-free, it doesn't mean that you should put off preparing for your RMDs. I want to stress again that your RMD strategy is one of the most important elements of your retirement plan. And having the wrong strategy is indeed one of the most common mistakes that retirees make with their money. And it's also one of the costliest. And the extra tax burden that it creates is really only one reason why. You see, RMDs start at almost 4% of your IRA balance. And of course, they go up each year as you get older. So if you don't calculate them correctly, the IRS can slap you with a 50% penalty. However, even if you do calculate them correctly, it's just as important to have the right asset allocation to satisfy your RMDs without running the risk of spending down your principal. In my experience, that means an allocation that can generate at least 4% interest or dividends. Because if you're earning less than that, you could be at risk of spending down principal just to satisfy these RMDs, which can be even a bigger problem than a larger tax burden. Now let's get to another one of your questions. Carol from Oregon asks, why do your RMDs increase as you get older? Well, basically, they're calculated based upon your life expectancy. And the goal of Congress is that by the time you get to a certain age, in your hundreds, it's completely depleted. I believe the age is 115. So every year you get older, your life expectancy is a little less. So therefore, the percentage you have to take is a little higher. Carol, thank you. Great question. And be sure to send me your retirement questions by emailing us right here at AskDave@theretirementinComeStore.com. Now, Jeff, I know that RMDs is something that can be really simple, and some of your clients have a good handle on it, but also can be really complicated for others. So it's something I know that, like myself, you deal with on a daily basis with your clients.
The best way for a retired investor to look up what their required distributions are going to be is to go to publication 590, and they can get that at irs.gov. All they have to do is type that into the search box. It'll show them how to calculate it and what their factors are. But if you're in your 60s, it's even a better idea to go look at that and maybe meet with an advisor to help you pre-plan. Should we take out distributions early, or should we wait until we're 72, Dave?
Yeah, because it's interesting because anybody could take the number, the life expectancy factor from Pub 590 and divide it into their IRA and 401k balance, right? But it gets tricky in a couple areas. First of all, as you know, certain types of annuities can actually increase the amount of RMDs. So it's a different formula if people have certain types of annuities. And also if you have money that is in IRAs, but you have some money in 401ks or 403bs that you've not yet rolled over to an IRA, then that complicates things, and those things have to be separate. Not to mention the fact that when you're trying to calculate the amount of taxes due, you have to look at how much of your Social Security might be taxable. So it's usually one of these things that I like to say, Jeff, don't try this at home.
Yeah, lots of different factors, lots of things to work on with a qualified financial advisor that can guide you through that process. But when we're looking at taking money out from IRAs, some people, Dave, will rely on their capital gains in hopes of having those without spending down principal, which can be a really slippery slope when you enter in the income phase or forced distribution part of your life. Whether you're taking out income in your 60s or required distributions, that is a very slippery slope, Dave.
Well, you think about it, even in a 20-year mortgage, most of your first payment is interest, not principal. But somehow the way the amortization math works, the darn thing's paid off within 20 years. So if someone is taking interest and dividends from their IRA monies and taking a little bit of principal, the math works exactly the same, where they can have that IRA completely depleted by time they're age 92. And as you know, Jeff, if they're in the stock market, now they're dealing with volatility and they're doing that thing we always talk about, which is reverse dollar cost averaging. I believe one of the most cancerous financial strategies a retiree can ever utilize. But to speak about that a little bit, I'm sure he's going to have some good feedback for us, is our next guest. That's income specialist David Mcadams, president of Mcadams Group, a retirement income store located just outside of Memphis, Tennessee. So Dave, you've got this Clark Kent look going here, which I guess is actually fitting because after all, I know you are Superman in the eyes of a lot of your clients.
Yeah, that's, I guess some of them feel that way, and especially my children feel that way, but I'm going to take the Superman compliment. I like that. I'll stick with that. Thanks.
Sounds good.
Well, Dave, your clients expect you to be the Superman of tax savings. So what are some of the most common questions or concerns you hear from your clients about their taxes?
Common questions or concerns. Right now, we're talking to our clients a lot about legislative risk. A lot of them are seemingly terrified about what tax law changes are coming down the pike, especially when it comes to capital gains tax, things that can traditionally disincentivize investors and savers and really hurt people during retirement. When you're trying to get income from those buckets, how do you get them out tax efficiently? So I'd say legislative risk. And we get a lot of questions about, should I do a Roth conversion, a Roth IRA conversion? Those are probably the two biggest things we hear from clients.
Yeah, we hear those a lot down here too, but there's also a lot of common mistakes that your clients and my clients and Dave's clients make with their taxes. So are there any other savings opportunities that you utilize that folks are missing?
Well, your show is the income generation. So a lot of your retired income generating clients are making a common mistake when they go to take their required distributions out of their IRAs. They often fail to understand something called qualified charitable distributions, or QCDs. And, in many cases, people have already determined that they're going to give some money to charity. They're not itemizing their taxes or taking a standard deduction. And by having the IRA custodian write the check directly to the church or charitable group that they want to give to, they can effectively take that amount right off the tax return. It's immediate tax savings, and it also goes towards the amount that they have to take out for required distributions. So I think that's a common mistake. And I would say, going back to the Roth IRA discussion, right now taxes are on sale. So you could make an argument, depending on your bracket and depending on a number of variables, there might be a small window of time where Roth IRA conversions could be beneficial for a lot of retirees.
It's funny, Dave. I've been in your office in February, March, beginning of April, and it's a zoo. I mean, everybody's jumping in, trying to get their taxes done and so on. But that's not the best time for your clients to actually do tax planning, correct?
No. So as far as tax planning goes, often if you start in January or February and you start planning for that tax year, you can often implement tax saving strategies that would reduce your taxes more so than if you wait till the last minute to do that. So you don't really want to wait till November or December to try to do your tax savings. You want to start earlier in the year. There's a number of things people can be doing now to try to increase their tax savings for the year. For example, if they're not already doing it, you should be maxing out your 401ks. If you're eligible for a health savings account, you should explore that. You should consider subsidizing a dependent care FSA if your employer offers it. And finally, you should do some tax capturing. Try to sell those dogs, try to get some capital losses on the books so you can offset capital gains. Those are some of the things that you can be planning for in advance as opposed to waiting till last minute.
Great words of wisdom there, Mr. Mcadams, aka Clark Kent, because unfortunately many think tax planning is January, February for the previous year, and you and I both know it's too late by then. So thanks so much again for being a friend of the income generation.
Thanks for having me.
And coming up, we'll be talking about some evergreen tax saving strategies that you might be able to use year after year. And we're also going to have special guest, tax specialist Joann Regan. All that and much more on the income generation. I'm David Scranton. During my career, I found that most baby boomers have done a great job growing their retirement savings, yet many don't know how to convert their savings into steady income. And that is why I built the Retirement Income Store. to help hardworking Americans preserve their assets and establish steady streams of income.
If you're 55 or older, our free retirement income kit is for you. It's chock full of information you need to know to get steady income during your retirement. Call 866-710-1749. Online at theretirementincomestore.com.
Welcome back to the Income Generation. It's great to have you. I'm David Scranton, and today we're looking at ways to help minimize your retirement taxes. And so far, we've looked at how different types of retirement income are taxed. We've talked about some new tax laws and the importance of having the right RMD strategy. But now, let's take a look at a few tax-saving strategies that you just might be able to use year in and year out once you've reached retirement age. For many, a quick and easy strategy is to simply take advantage of the higher standard deduction offered by the IRS to those age 65 and over. Single filers in that group were able to increase their standard deduction by $1,700 in 2021, and joint filers were able to increase it by $2,700. And as you may know, you need to have more tax deductions than the standard deduction to make itemizing on your return worthwhile. And even then, the standard deduction might still make more sense. Another strategy that just might work for you involves spousal IRA contributions. Even if you're no longer working, but your spouse is, he or she can contribute up to $7,000 a year to an IRA that you own. As long as your spouse has enough earned income to make the contribution, this tax shelter remains open to you. And speaking of work, if you become self-employed after you retire, let's say as a consultant, you can deduct the premiums you pay for Medicare Part B and D on your tax return. Another popular strategy is to have any payout you receive from a pension, annuity, or other source sent directly to a rollover IRA instead of sent to you. As long as the check's made out to the account instead of you personally, you'll avoid the automatic withholding that's required by the IRS. And again, these are just a few strategies that may or may not be right for you, depending upon your situation and your retirement goals. And now let's take one more question from you. Donald from Kentucky asks, what do you expect to be the biggest impact of Joe Biden's tax plan for retirees? Well, gosh, I wish I had that answer. I know I tried to pump Dr Laffer for an answer to that, and he said that he thought that most of the things, as you heard, are simply not going to come through. Everything is going to be compromised in some way, shape, or form. But I think he's right in saying that ultimately the biggest tax could be if they get rid of the step-up in basis at death, because if that happens, it's not a tax you have to incur, but it means that assets such as your home that may have appreciated in value, your heirs may have to pay capital gains tax on it when they receive it. So again, not a big thing for you, but for your heirs, it certainly is. Donald, great question, and thanks for writing. Once again, be sure to send me your retirement questions by emailing me at askdave@theretirementincomestore.com. Jeff, I know we seem to be running out of these evergreen things that we can do to reduce taxes, but let's talk about some other ones.
Well, you know, Dave, municipal bonds are something that somebody could do that's more of an evergreen approach to avoid taxation. However, municipal bond interest does count towards the calculation of taxation on your Social Security. And most folks don't know that, Dave.
Yeah, and if you're in a high tax state, then the only way to save the state income taxes is to own bonds exclusively that are from the state in which you live. And then you're not as diversified. So as a practical matter, assuming you diversify, you're only really saving federal income taxes.
Which, depending upon your tax bracket, can be really, really large. But there's another problem there. Municipal bonds aren't paying enough today, Dave. They're not. The new ones aren't paying that well at all. But if you were lucky enough to own a muni bond before 2020, then you need to hold on to that muni bond, because that's going to really benefit you financially from a taxation perspective and by way of a yield on that bond.
Well, and that's part of the reason, too, why most people don't have a lot of experience buying municipal bonds, right? What do? They buy mutual funds in their 401k when they're accumulating. And if you try to get cute and upon retirement invest in those things you've never invested in before, then at the end of the day, you can make some major errors. So like I always like to say, don't try this at home.
Don't try it at home. You've got to have a professional's help with these types of strategies, whether it's a tax professional or a financial professional. You have to work with a pro to help guide you through the process.
Yeah. And Jeff, as our last guest, Dave Mcadams, said, at the end of the day, the time to start thinking about tax savings is not February, March, and April. It's the previous year. It's the previous January for that year. The earlier, the better. And our next guest, our final guest, income specialist and also tax specialist, Joann Regan, knows a thing or two about saving taxes if you're retired or approaching retirement. She is president of Financial Security Group, a retirement income store located in Glendale, Arizona. She has been helping clients with tax, estate, and retirement planning, that trifecta we talked about earlier in the show, for over 20 years. Joann, thanks so much for being back here with us on the Income Generation.
Well, thank you. Great to be here. Great to be able to help with anything I can give our clients and give them some knowledge that they can use.
Great to see you. Welcome back on the show. You know, lots of discussions about taxes going up next year and how it's only going to affect the rich. But the one thing I haven't seen is another threshold of taxation on Social Security besides the two that we have for married people, for single people. So will there be another threshold of taxation on Social Security? Do you see that in the future?
I do. I feel like when they have to pay down some of this debt that we've incurred, they're going to be looking at all options and all alternatives to try to get that paid down. And I do think that Social Security will end up being part of that, as well as a lot of other things that, currently may not be taxed, like the stepped up basis and so forth. I think we're going to see a lot of changes in the future.
So I guess you would probably surmise then, if we don't want the tax code to change, then you, without sounding political, you have to vote in a particular fashion, correct? To avoid taxes going forward is probably the best strategy.
I think that's correct. I think that no matter what type of administration we have, a lot of them run on a tax platform. And again, without being political, we do have to vote according to what platform we believe is going to be more beneficial to ourselves.
All right. I'm just going to say it. I'm taking the gloves off. We got to vote Republican. That's the best tax saving strategy we have going forward. I'm sorry, Dave, but I had to say it.
Brave soul, brave soul.
That's great. Well, of course, yeah, it's they tend to be more tax friendly, but unfortunately, we've gotten ourselves in a situation now where we have to pay the debt somehow, and all these extra things we're spending money on, and it'll be interesting to see how it all unfolds. But Joann, I want to focus on how our clients, your clients, people who are retired within 10 years of retirement, how they could be affected by the laws that President Biden is trying to push through. What do you think are the components of it that are the most dangerous to our clientele?
Well, obviously, the elimination of stepped up basis is going to be the biggest one. If that does come to fruition, I feel like that is really going to impact everyone, but particularly our clients that are, going into retirement, and how are they going to prepare for that? How are they going to get rid of some of those assets that are, potentially going to cost their heirs a whole lot of money? So I would say that one is going to be the big one.
Yeah, once you get rid of stepped up in basis, then the government just has to increase the capital gains rate again, and all of a sudden they've essentially written themselves a check, if you will. So what are one or two good tax saving strategies that you like to recommend oftentimes to your clients that you find that they just seem to miss or overlook?
Well, I think that a lot of times I see people taking money out of their accounts that they're not using. And by that, I mean their qualified accounts, and they're not using it. And the reason why they're taking it out is because they think that if they can get it into another account and they've already paid the taxes on it, because they think taxes are going to go up in the future, that's going to be beneficial to them. And that doesn't always work. That isn't always a good strategy, because what they put the money into doesn't necessarily pay them any income at all. So I try to recommend to them, if they're not going to use the money and they want to take money out, maybe using what's called a qualified charitable distribution, or a QCD, where they can take the money directly out of their qualified account, send it to a charity, get a big tax deduction for it, and not have to pay tax on that money. That's a strategy that they use a lot in my practice, and I feel like it's very beneficial to them if they're taking out too much and they're not using it.
Yeah, it And you're right. If you're going to take money out, today's brackets, I feel like if you're in the 12% marginal tax bracket, okay, go ahead and take some money out of your IRA if you don't need it because it's a low bracket. But if you're higher than that, it usually doesn't make sense. People forget that paying $1 of tax years later is always better than paying today because they get to keep that dollar invested. So Joann, thanks so much again for being back with us here on the Income Generation.
Well, and thanks for having me. I really appreciate you.
And thanks to you for joining me once again on the Income Generation. And thanks to Jeff Small and all of our guests. We've had a great time. Bottom line, if you're close to or you're in retirement, you're concerned about your money, it's essential you stay informed and up to date. And as you know, right here is where you can do it on the Income Generation. I'm David Scranton, and don't forget to tune in next week.